All right, Josh, welcome to the Resource Insider podcast today. Where are we finding you?
I'm here in Houston, Texas.
Okay, well, look, I reached out to you a couple weeks ago. I have been looking forward to this podcast. I have probably 800 questions sitting in front of me that I want to ask you, and we're not going to get to all of them today. But you know, as way of background, Resource Insider podcast has been around for almost 8 years now. We've focused primarily on mining and metals, which is my background, my expertise, and we've had some great success there. But over the last several years, in part because of the success that I've had and our readers have had investing in the kind of the energy metals, I've gotten more and more fascinated with oil and gas and other forms of energy. I've started following you on Twitter. You've got an excellent Twitter account. You've been on lots of podcasts and lots of interviews. And you're someone whose views I've sort of started to listen to and admire in this space. And I thought it'd be great to you on here so you can help educate me a little bit about oil and gas, particularly oil, where I would say I'm the least knowledgeable, and also our audience, who many of whom I think are on a similar journey to me and recognize the value proposition in oil and gas, but maybe haven't positioned in that yet or don't understand it as well as they might mining and metals.
Sounds great. The one thing that popped to mind as you were saying all that, I really appreciate it. I want to meet this Josh guy, and what I found is that the more I learn, the less I realize I know. So, I'm on this journey too, trying to figure this all out. So happy to help where I can.
Well, let me start there because how did you end up getting into oil and gas? Are you from an oil and gas family? Are you an engineer? Or what's your background into that space?
No, not at all. So I studied economics at University of Chicago. I'm from Santa Monica, California. Um, I worked in management consulting coming out of school. It was sort of a logical transition, like sort of real world application-ish of studying economics in the sort of University of Chicago, sort of very intense,
Hmm.
comprehensive sort of way. Um, I ended up not liking that because it was sort of too theoretical and went to work for a private equity fund and generalist lower middle market buyouts. I had this fantastic, inspiring intern there who's now a world-renowned influencer and writer, Morgan Housel, and we sat in a
Oh
room
yeah,
together for
yeah.
3 months, and he convinced me that I should pursue my passion, which was value investing, and leave private equity, generalist, whatever. And so I went to work for a multi-billion dollar family office doing public equity investing and ultimately helping run their energy exposure, and this was in the 2007 to 2010 period. So that's sort of where I got real interested in the space. And so, a number of different misadventures and challenges and problems and so on, and ended up in 2015 co-founding Bison, focused on publicly traded oil and gas companies. Basically, the space had gotten destroyed. Everyone was pulling money out of publics. I think there were some like 100 public equity funds focused on oil and gas or similar strategies, and now there's maybe a handful, maybe not even that many, at least
Yeah.
focused on North American.
So I this is going to derail our conversation a little bit, but I feel like I have to ask this question. How does someone's intern convince them to totally change their career path? That speaks very highly to the persuasiveness of Morgan. I mean, obviously, and that has gone on to reflect in his career so far. But what did he say to you? What was he doing day in day out to convince you of that?
Well, really, so what was happening was it was early to mid 2007, and so the deal environment in private equity was slowing. You had the quant blow up right around then. You had banks and hedge funds that were doing lending. It was lower middle market at a time where this was sort of like the almost the cowboy years for, private equity. Private equity was
Hmm.
much less understood as an asset class, and so the ability to do deals was falling apart. Um, and so we were working on deals, but there wasn't really a lot to do in terms of completing deals. And part of why I was there was to come in and on recently acquired things, help fix them, sort of apply the consulting stuff I'd been doing and go fix companies. And I was doing some of that, but really there was just a lot of downtime. And then a lot of, I think, you were working for a young team and they had a relatively, I guess, big fund in retrospect, considering, inflation adjusted, whatever, but it was a couple $100 million they were deploying. And so, they weren't really sure where they wanted to go. So they would come into this room I'm sitting in with Morgan staring out over, we were in the Twin Towers in Century City in Los Angeles, and, staring out to the beach, whatever, like talking about, hey, like which things should we buy? And, the running conversation was, hey, like which stocks are you buying? Which fund managers are you following? We talked a lot about Monish Pabrai, and various Buffett and various other sort of famous investors. And you know I don't know there was any one individual thing. And it's actually sort of funny, right? Because Morgan was so set on becoming a value investor and ended up writing books and sort of becoming this sort of like popular sort
Yeah.
of value investing sort of, or just passive investing figurehead sort of. And I ended up doing the thing that he wanted to do. And there he is convincing other people to sort of think rationally about money and investing. So, again, that's one of those things where you never know really who's going to influence you and how they're going to. And I, I'd already been investing a lot on my own personally. I loved it. I sort of funny. He ended up going to write for the Motley Fool after that,
Hmm.
and I had read as a kid. I used to read the whole newspaper, and I was really cool at 8. And so I really liked the Motley Fool column, and I got some money. I was 10, and then like bar mitzvah money, sort of the cliche whatever
Yeah,
thing,
yeah.
and opened I think it was a Scott trade account or something, walked down the street with my dad and got to open it and whatever, and put money in and started buying these things that they were talking about in the Motley Fool newspaper column. So I'd been doing it for a while. I liked it. I knew I was like I really enjoyed it. I loved talking to Morgan about it, loved talking to whoever would talk to me about what they were investing in and how they thought about it. And so, I mean, I didn't take a lot of convincing, I guess I would say.
And you went to this family office, and did you go there thinking you'd be focusing on energy, or is that just sort of how it turned out?
Yeah, it's more how it turned out. It was a very interesting, sort of odd experience. Every family office is sort of its own thing, and these guys, they just were really interested in energy, and they had a lot of exposure to it. And at the time, many different public equity managers were really focused on energy because I think oil and gas stocks were something like 15 or 20% or something of the market at that point. You were sort of
Hmm.
in a bubble for oil in that 2007, 2008 period. And so there was a lot going on in oil and gas. And it was something I liked the people and I liked evaluating the businesses. And I think, honestly, I think I didn't know what I didn't know. And so that made it even more appealing than
Yeah,
maybe
yeah.
it should have been to me at the time. I had no background in engineering or anything like that. And, I will say the one benefit of that is over my career, I've seen people with specific backgrounds use those backgrounds and ending up sort of blowing themselves up. And again, I've made plenty of mistakes and lost plenty of money in different sorts of things. But there's a tendency for engineers to preference optimizations and geologists to poke holes in the ground and XYZ other expertises to whatever, and finance folks to go overly financially engineer companies. And I think not having really any of those backgrounds, coming at it from economics and some more sort of intellectual theoretical perspective, along with sort of these roots in value investing and just reading and following all these different value managers over time, I think it's sort of kept me out of trouble in a number of different places and ways that most of my competitors since we launched Bison in 2015 are gone. And so whether they were smart and
Yeah.
went into stuff that boomed, or whether they were had one of these problems, either way, I think it's actually been really helpful to not have had that background. But I didn't know that at the time, and there's a lot of mistakes that I've made in between starting to invest professionally in oil and gas stocks in 2007 and where I'm at here in November of 2025.
I mean, I think it's that kind of phenomenon you see sometimes people from another industry or a peripheral industry move into something and end up being incredibly successful, or in some cases dominating that industry, right? Because they take an adjacent but similar playbook and put it to work there, and they're kind of they're playing a slightly different game that attracts more capital or more opportunities or whatever it might be. And you kind of see that again and again and again across different sectors. And it sounds like you've experienced a little bit of that phenomenon yourself.
Yeah, here I am, guy from Santa Monica with
Not
a
oil and
driller
gas country,
bobblehead in the
yeah.
background. Yeah, yeah.
Yeah. All right. So okay, in 2015 you launched Bison Interest. You're the founder and CIO today. This is a oil and gas focused investment fund. What was the thesis behind starting this? What was the plan and how has that evolved over the last decade?
Yeah, so I co-founded it. My co-founder was a private banker at UBS, and he and I both saw folks set up various opportunity funds and SPVs and whatever around the financial
Hmm.
crisis and become phenomenally successful. And we saw the oil price crash in 2014, and small caps really get destroyed in oil and gas. And it felt like just sort of a bigger version of some of the mini cycles that you had seen in oil and gas over the bull market from 2000 to 20, or really 98 to 2014. And so the thought was, hey, using that sort of framework, and again, if you look back, it's like, hey, that's ridiculous because shale was booming and whatever, but no one knew that there was going to be this big discovery of the Delaware Basin.
Yeah, yeah.
Midland you sort of knew, but the Delaware Basin was a surprise, and the Montney sort of get revitalizing, and Duvernay and some of this other stuff. There were some big surprises there from a supply perspective from where we were sitting in early 2015 looking at this. And so I thought was, hey, this is like sort of a 3-year opportunity. We'll come in and buy a bunch of these small caps. I think the sort of model profile was 4 times EBITDA, 2 times market cap to EBITDA, 2 times debt to EBITDA at, let's say, $50 oil. And that
Hmm.
as you went from 50 back to 100, you'd delever a little, you'd grow a little, and you could end up with sort of a 3 or 4x or something from there over a 3-year period. We looked at prior periods where that had worked. We looked at the opportunity set, and I've been doing a bunch of sort of one-off special situation type investing, and the thought was to take a bunch of those, put them into a portfolio, and maybe get some additional return, which ended up that part we caught in spades. Like we did really
Hmm.
well, I think, relative to small cap oil and gas, but there was not that uplift. In fact, we were very wrong. I was very wrong, and small cap oil and gas stocks proceeded to derate from 4 times to essentially 2 times, and now they're starting to re-rate very slightly. But the valuations really sort of the multiples collapsed, and many companies failed or got bought out for low premiums or so on in between 2015 and now.
Okay. So, I think back to when I started the Resource Insider newsletter. And I would like to claim brilliance on this, but it actually turned out to be sheer luck in that gold was about $1,200 an ounce at that time. So we started the newsletter at what turned out to be the very absolute bottom of the gold market, which is where we were really focused early on in making investments in that space. And we made many in those first sort of 2 years. And that brought us to, 2020 or so. COVID hit, gold had a spike, everything went up. We ended up looking very, very smart. We made several investments at the top of that peak rather. Then it came crashing back down, and we ended up looking fairly stupid, and it kind of balanced out in the fullness of time. And it was a very, very big and somewhat painful learning experience for me of like the importance of being early, the importance of not chasing deals, the importance of not chasing a commodity. And ever since that time, we've really focused on trying to buy, how would I explain this? Try to buy the companies that we believe will provide us the best leverage in a commodity that we're bullish on at or near the bottom of that cycle. And we've had a lot of success in that in uranium and in copper and in lithium. And now I look around and gold is at all-time highs and ticking higher it seems every day. And we are in a position now where we're kind of selling off some of our positions in there and thinking about redeploying capital. And when I look at oil today at, in the high 50s, low $60 range a barrel, I just see my gut feeling is I'm seeing a lot of the same dynamics that I saw in the gold market in 2018, where everybody hates oil right now and no one is interested in it. And I look around the ecosystem of commentators, and then you are a kind of a lone voice out there in many ways, trumpeting the upside there. And that gets me really interested. So I'm going to ask you a question after that soliloquy. You probably don't get very often, but like, what is the bear case for oil today? Why would someone say you shouldn't be investing in oil today? And then let's talk about why you see things differently after that.
Sure. So first of all, I'll quote Rick Rule, who actually I think has come around to sort of a similar thing to what you just described in terms of early in resources did real well, and then now shifting over to oil.
Yeah.
Um, and what does he say? His short-term track record is not marred with success. So I like to say my short-term crystal ball is broken, and so. I won't proclaim that I know when exactly oil prices have bottomed or will have bottomed. I'll post on Twitter, hey, bullish oil, whatever. But I think over a multi-year period, we're going to see oil prices go much higher for reasons I'll get into. The short-term thesis on bearish oil is extremely easy, which is that the IEA is forecasting a 4 to 5 million barrel a day glut oversupply relative to demand over the next year.
Hmm.
And if you look at the past, that's the largest on a volume basis ever, and it's close on a proportionate basis to the oversupply you saw, the very temporary oversupply you saw in 2020, which sent oil prices negative. So that's the bear thesis, and then that's supported by a increase in measured oil on water in the last few months, which has sent the quantity of oil on water up by hundreds of millions of barrels, indicating some tangible evidence of a significant glut. That's the bear thesis.
And is this
Oversupply
oil
right
on
now.
water? Does that mean it's oil currently being transported in tankers and whatnot to a market, or are those tankers being used as storage because there's so much of a glut? How should people think about oil on water?
Yeah, so that's the bear thesis, and every clarifying question and every thought about that pretty much leads you bullish rather than bearish, which is what has me so interested in this, right? The cheapo high level is, hey, there's that, right? So one, the
Yeah.
IEA has been very, very wrong. Their long-term track record is not marred with success. They have done these very long-term sort of wrong predictions, and then they'll do sort of kitchen sink write downs where there'll be a billion or 2 billion or whatever, like some giant number of barrels that are missing in reserves, and they'll just in storage, and they'll just get rid of them on their spreadsheet or whatever. So they've done that once already, and it looks like they're on track to doing it again. So that's the starting point, is like understanding where this is coming from. Like the same folks that are trumpeting this. So there's the IEA,
Yep.
there's the EIA, and again, we'll get to sort of the specifics, but I think it just helps to lay out sort of the cast of characters and where this is, where the
So
information is coming from and how it's getting
IEA is the
disseminated.
International Energy Association. What's
Yeah.
the
And then
EIA?
the EIA, so the IEA is technically an NGO, which was formed by Henry
Yeah.
Kissinger when he was the Secretary of State. So sort of quasi like Western government affiliated. The EIA is the Energy Information Association, I think it is.
Okay.
It's a U.S. government agency, uh, and it's controlled by the Energy Department, or Department of Energy, which Chris Wright now is
Hmm.
the head of. And so the EIA and the IEA both were formed to try to give sort of like accurate measurements to try to reduce the odds of there being some sort of shortage of oil. But they've both been sort of repurposed. The IEA has been repurposed to push a sort of clean energy, anti-fossil fuel sort of stance, which they do to a greater or lesser extent over the last decade. And
Yeah.
there was a big uproar when they stopped forecasting, or they added a forecast that oil demand might not collapse right away recently. And just seeing
People were
um,
offended that they put that in there. Is that the
yeah,
idea?
Yeah. And again, like when you see that, it's like, oh man, like is anyone taking this seriously at all? And
Yeah.
again, like between that and the kitchen sinks, like, but that's the people use their forecast that goes into all the investment bank models and it goes into almost all the, expert consultants, whatever.
And so they're
And
not
then the EIA,
predicting as much as advocating almost in many
yeah, they're
ways.
wish casting.
Yeah. Okay. And the
The
EIA, sorry to cut
EIA
you off.
is also wish casting, which is that you've had Trump and then Biden and then Trump sort of trying to force the oil price lower in order to like manhandle inflation. And it turns
Hmm.
out that you can successfully manipulate the price of a commodity lower for a period of time. The problem is that when you do that, you end up with the inevitable consequences of that, which is an undersupply and way higher prices. It's the ironic thing about the IEA and EIA, which is that they're supposed to be there to prevent this thing, and instead they're pushing this thing. And
Yeah.
so the IEA sort of has these weird sort of green stuff. The EIA was doing that under Biden. Now it's just trying to force the oil price down. They have these weird forecasts that also sort of make no sense in different ways. And you sort of get to a similar thing as the IEA with like a less green push, but still this sort of like extreme bearish wish casting. There's things that don't make sense, like projecting higher US oil production and an even lower oil price while also incorporating the Dallas Fed does these measurements of producers and polls and stuff, and the EIA is using a forecast price that's way below the stated break-evens from the Dallas Fed, for example. It should be an input, given it's also a government agency, sort of tied
Hmm.
in. And they're forecasting higher volumes, but at even lower than break-even sort of price for producers. And so it's a very odd thing. So the data is coming from these guys, and then it's coming from a set of expert consultant type firms that are barrel counters that I think were very valuable a decade ago when it was really expensive to get AI analysis, or it didn't even exist, really expensive to get satellite imaging, really expensive and hard to get all this other stuff. The reality is that that's all a lot easier. And so the best I can tell, without naming any specific names, it appears that the new business is to sort of scare people into subscribing. And so, which is brilliant, right? Frankly, like I've thought about competing in this space. I might, we launched this newsletter thing. Hey, why not go and do sort of the same sort of nonsense? I try to not put out anything I don't think is real, but there is this sort of weird high price competition on, who can be most bearish or who can whatever. And so you have these guys and the banks sort of somewhat echoing the EIA and IEA and somewhat also coming up with their own analyses and forecasts, but they're always tying back to the EIA numbers. They're always tying back to the IEA numbers. And so you just have this like, from what I can tell, garbage in, garbage out dynamic. And so I think I just wanted to explain that because it sounds sort of crazy to say, oh, well, they're all wrong. But I mean, they're starting from a bad premise with like a weird political bias.
Yeah.
In one case suppressing inflation, in the other case trying to push the green energy thing. And I think that's where it comes from is, hey, wait a second, I don't care. I just want to make money for myself and my clients. I just want to find things that I think can do better than other things that I can understand. And so that's my approach and my starting point. And so to me, looking at a mess like this, where everyone's sort of like staring at each other while like, referencing this stuff that's dumb and wrong and very, very politically biased. I mean, it's a great place to come in and say, hey, well, this is wrong and this is wrong and this is wrong. So, hey, yeah, I could be off on this by a little, but I'm probably going to be right on this. Not necessarily in any given moment or any short term, but over the medium to long term, this should go horribly wrong for all these guys, and here's why, and maybe here's 3 or 5 reasons or something why it's going to do that.
And so clear case for the short-term bears. Now, what's the case for being long or maybe medium-term bullish on oil today?
Yeah, so the long-term bull thesis, which we saw in 2015, and it's only gotten better. This was the tailwind that said, hey, if this time's different, we're still fine. And the long-term bull case is that exploration for oil collapsed in 2014 and it
Yeah.
peaked in 2012 with China. So when China went into decline in 2012, like in real decline, they started printing
Hmm.
money, whatever, but like China's real expansion ended in 2012. Everyone forgets this. They all whatever. They build all these ghost cities, and they never really sort of they stimulated out of it, sort of, but like it ended. And so when it ended, all these commodities went into horrible bear markets, and exploration by and large collapsed, not just for oil, but sort of across commodities. And so for oil versus some other commodities, you can't recycle it, you just burn it. And
Yeah,
so
yeah.
you have a much bigger problem than, for precious metals, like for a gold or whatever, like your problem is that you have more and more of it over time. And so you need to absorb it. You need money printing in order to drive absorption of existing and then additional mined ounces. With oil, you don't need that because you have depletion of existing discovered reserves and then destruction, incineration, combustion, whatever, or use in chemicals that then end up sort of recycling basically doesn't work for most of that stuff. And so you have destruction of almost all oil ever produced up to like 45 days ago, or if you believe the IEA, 60 days ago. And so that's really positive long term because if you have depleting reserves, you have diminishing supply from existing fields, you need to not only reinvest, which industry has been doing in sustaining existing supply, but you need to go do more exploration to discover more stuff and then more delineation. And there's been a little of that, but historically low amounts relative to what had been done historically. And then
Hmm.
the discoveries have been incrementally smaller, not bigger. So smaller discoveries and fewer of them, and that's leading to this problem where, there's different manifestations of it, whether it's OPEC Plus having issues with their spare capacity, Saudi break-evens skyrocketing, other oil company break-evens skyrocketing. Um, and there's various other, I mean, you can just measure the discovered reserves and announced discoveries and so on, and then look at delineation activities where more often than not, delineation ends up with less oil in place and higher break-evens than initially thought across the world.
This mirrors the copper market in so many ways to me. It sounds so very familiar. And so where are you in the M&A cycle? Are you seeing the sort of majors and super majors buying up all the mid tiers right now to replace reserves that they're not organically replacing with discovery?
Yeah, we're in the middle of a merger boom um, and acquisition boom. And so it's always good, I think, to take these with a little caution because M&A typically happens either at the top of the cycle or the bottom of the cycle.
Yeah.
And I feel pretty good that we're not at the top of the cycle, but there's always the chance that, hey, totally wrong. IEA was right for the first time in a while, and their green agenda sort of ended up mirroring reality for the first time in what, a decade plus or whatever. And so it's possible. There's always risk. There's always, we launched Bison in 2015, and there were these huge wells that started coming on the Delaware Basin in 2016, and I think there's now something like 2 million or more barrels a day of oil produced from a thing that did not exist pretty much. I mean, there were some very old
Yeah.
legacy vertical wells or whatever there. And there's an extra million barrels a day from the Midland Basin. There's been ramp ups in various other places. The oil sands are working a lot better. There's always a risk of incremental supply, big improvement in technology or efficiency or whatever. But by and large, I think that's really that's the setup. And then you referenced copper. Copper is at basically its all-time high price. Oil's near its all-time low price on an inflation-adjusted basis. Just radically different. There's lots of exploration efforts for copper, whether people like to admit it or not or whatever. A lot of the gold exploration efforts are
Hmm.
also copper exploration efforts. It's sort of a different dynamic. Oil, I think, is a few years behind the gold market, and I would argue is similarly behind the copper market. I don't know that I believe some of the demand estimates for copper, just sort of incidentally, which I guess other folks would look at oil and say they don't believe them. But the oil ones are, hey, I think it's going to grow by 1% a year because it's grown by 1% a year for 40 years. Whereas copper, hey, it's going to double. Okay, cool.
Yeah.
Like when, where, why? Tell me about Chinese building and like how much less copper demand there'll be there to offset some of these other demand factors or whatever. So
Yeah, I mean,
again, a
so
little
much
more
of that
complicated.
those predictions are tied to green energy and electric vehicles and pretty aggressive adoption rates of that, I would say, which we're probably not, we're definitely not seeing and might not ever see. So I see where you're coming from on that. But you're in the middle of an M&A cycle right now. I mean, let's assume that it's at the bottom of a market, right? So When does that capital shift from M&A to exploration? And are you seeing any of that yet in oil or gas?
You're actually seeing it shift away from that, interestingly. So Chevron just cut their capital program by $1 billion after going and buying Hess. And
Yeah,
they bought Hess to get into one of the great last discoveries, which Hess really drove, which was Guyana, offshore
yeah.
Guyana, the Starbuck block. Phenomenal wells, really truly impressive, tremendous value creation in the middle of a time when people were really not doing that too much. Um, and it's very interesting to see that in the context of this problem. You're also seeing Exxon sort of move away from exploration. They bought Pioneer, so they bought
Hmm.
Shale after inventory had likely peaked and started depleting. Scott Sheffield has come out subsequently and talked about how he thinks there's only 3 years of inventory left, which is sort of funny. I wonder how Exxon feels about that. And this would not be the first time that Exxon lost a lot of money on an acquisition. It would be, there's been many of those. It used to be fun. I would write these articles on Seeking Alpha just for fun, whatever, to get feedback. And it's like for a while, you could just write about oil major multi-billion-dollar write-downs from their like poorly thought through, poorly timed acquisitions. And there were just so many, like there were more of those to do than I had time or patience to actually write about. The reason to highlight that is that these are the companies that should be leading the way. If you look at what like Exxon and Chevron are really good at, it's not drilling 500 onshore wells and optimizing them. It's just not what they're good at. They don't have the cost structure for it. They don't have the people for it. It's not what they built in their organization. It's not in their DNA. There's no part of Exxon or Chevron that's good at that. And you can actually tell there's actually this sort of weird thing that I think is relevant to all of this and understanding like the brokenness of the current oil market from a producer perspective and why there's going to be so much higher prices. So Exxon and Chevron, their whole business, the business model was innovated by Rockefeller, right? And Rockefeller didn't come at it from a producer perspective. He came at it from a pipeline slash rail perspective and originally refining. And so if you look at their businesses now, they're basically scattershot. They're like the high cost, low quality producer in the Permian, and they go and buy stuff in various other places. They just were in a bidding war for a Guyana asset. They have their refining assets and chemicals assets spread all over. And they've both spent huge amounts of money developing out these West Texas fields that and southeast New Mexico that again they're not particularly good at. Like on a rock adjusted basis, they have very poor results. On a unadjusted basis, they have like middle of the road results, but they have the best rock because of legacy positions and because of their
Hmm.
acquisitions. So what they haven't done is the Rockefeller game plan, which is to come in and optimize the midstream and optimize their upstream operations and fully integrate it with their refining on the Gulf Coast, change their refining and upgrade it to be able to actually use the volumes that they produce, integrate that in with their chemicals businesses, and then just focus relentlessly on being the lowest cost in that sort of integrated supply chain in order to deliver gasoline that's superior and lower cost at the endpoint that their competitors would be unable to compete with by not being integrated.
They have not done this.
Right. At all. Exxon's
So,
done it a tiny bit, like one
yeah.
hundredth of what they could do.
Why? Like, what do you make of that? That seems like a pretty obvious value creation case. Why? What are they missing?
Well, partly I think they bought in at least partially to the sort of peak oil thing. So, hey, if you
Hmm.
why do that when you can go invest in sort of lithium brine extraction in Arkansas, or go bid against your competitor on this sort of big, sexy offshore field that you'll go lie to everyone about and say it's break even. There's a race to the bottom on that stuff. They used to do it with shale, where one producer says, "Oh, I'm $50 break even," the next one, "Oh, I'm 45," and they you get to there were some estimates where shale was supposedly break even at 28, and you look at the financials and there's no basis for that at all. The financials are break even at 70,
Yeah.
and or they were at the time, and they were claiming 28. Similar on this offshore stuff. So I think misaligned incentives, broken organizations, complete sort of strategic disarray from I'll still see these guys at conferences and stuff. I was at a conference recently where there were some folks from some of these super majors, and they actually thought this was a great point. And they said, look, we can't do that because I'm in the refining business or I'm in the upstream business, and we don't talk to the refining people. We don't talk to the upstream people. We're in our silo, and yeah,
So
our
no
CEO
one's
manages those.
overseeing the kind of end-to-end product line, right? The kind of
The
soup to
C
nuts approach.
Yeah, the CEOs, but okay, like, and that's where like all of a little pushback on some of the generalists that are getting into oil and gas and say, oh, Exxon should triple or whatever. Come on, like Exxon should like figure their stuff out. They should stop having refineries blow up or catch on fire every year or two or three. Same with Chevron, same with Shell. Same, these guys really like they have very sort of broken organizations. And again, you can see it. There's these external manifestations like bidding wars on offshore assets that are not attached to their sort of integrated complexes. And then, I mean, the air quality in Houston is too frequently bad because you'll have these refinery fires and chemical plant fires and explosions. And again, I think that's not intrinsic to the business. You don't need to have refinery explosions. You have them because they underinvest in the maintenance because they don't prioritize it because it's a cost center, it's not a profit center. But it's ironic because Standard Oil was the exact opposite. It was, hey, let's relentlessly optimize this stuff, and you're really, really far. So again, why does that matter? Well, you have the companies that were set up, right? So why they deviate? They deviated from this in order to be international exploration machines when we were running out of oil in the last
Hmm.
cycle. Everyone was worried about peak oil in 2000, 2005, whatever. And so they're not even doing that anymore. They've pivoted away from that, and now they're sort of these like lost entities. And so there's not exploration like you'd need. There's not delineation like you'd need. There's not even the optimization that they could do that would make a lot of sense. And so without that, I think you end up with much higher prices. And I actually think these oil majors end up they're strategically misaligned, and so I think you end up with them not being the beneficiaries because they have so many challenges and issues within their organizations and within their asset bases.
So I'm really glad you brought this up. This is one of my favorite sort of talking points and one of my kind of core theses. So my whole career, probably yours as well, across markets in general, across the stock market, we've seen almost every business kind of broken down into its smallest conceivable parts, right? They're all split into small, hyper-focused businesses, right? And there's a lot of good reasons for that in public markets. People want exposure to a given thing and they want them to optimize for that given thing. And we've gone from seeing maybe in the 70s or 80s like the conglomerate premium that maybe the Enrons used to get or the GEs used to get to the conglomerate discount now, right? That so many of these things are discounted because they're too big and too complicated and too bureaucratic. And we've seen most things break apart, but now I feel like in the tech world, we're starting to see this real push towards vertical integration. When you think about like a SpaceX or an Amazon or a Tesla, some of these companies that are kind of trying to control their whole supply chain and create every aspect of their product from sort of ideation to end of the assembly line. And hearing you describe the inefficiencies and ineffectiveness of the super majors, it makes me wonder, like, is that model dead, or is it perhaps just not being done correctly? And there's some incumbents, there's some smaller companies that are trying to do that now, what you've described, right? Like they have their product, they have their assets. Their goal now is to get it out of the ground as cheaply as possible, get it to customers at the best price with the best margins possible. Do you think that's something we're going to see these sort of new vertically integrated companies arise in the energy sector, or am I just kind of fantasizing about this?
No, no, I think you're seeing it. I think like one example would be Suncor, where they were doing a quite poor job of this. And then Elliott came in and replaced the management and I think at least some of the board. And they brought in, incidentally, a former CEO of Imperial Oil, which is a subsidiary of Exxon in Canada, who had done a great job. Imperial is probably one of the best examples of what to do right, where you tightly integrate everything, you manage it extremely well, constant cost efficiencies, focus on returning capital, focus, and they've done that business unit is fantastic, and it's an integrated production, and it's oil sands to, I think they even have gas stations all the way through, and
They
very
do. Yeah.
efficient. one of the lowest cost models, really great. And so Suncor's doing that too. I think it's actually one of the things that's really helped the Canadian oil and gas companies, and where you're starting to see more of a multiple up there is the success with Imperial, and then that success being replicated with Suncor. And I think it's starting to be replicated by a couple more of their competitors. And so I don't know. I think that the problem is with tech, you can sort of create it. There's network effects, but you can sort of create it out of scratch
Yeah,
to
yeah.
some extent, especially if the other guys, what was it? Whatever came before Facebook, it was the MySpace. It was really, it was good, but like they had lots of problems, and so you don't need like MySpace to refine itself. You just create Facebook, and it kills
Yeah,
it.
yeah.
There's not really room for that in oil and gas per se because these are fixed assets, and so someone needs to buy them. But I mean, Exxon and Chevron and Shell, et cetera, are terrible sellers. They'll sell these things for pennies on the dollar when they sell. But like I was alluding to, their big write-downs and transactions and so on. But it's real hard to get. I don't know that they're going to go sell their, West Texas to Gulf Coast plus, the refining plus chemicals plus gas station whole thing like that. They should, right? They should spin that out and it should be its own thing. And they should bring in someone to just manage that and have it be sort of a super fantastic integrated company similar to Imperial Oil or Suncor. So I don't know. I'm not sure there's room for the whole thing to fix itself. The reason I went on that tangent, though, is that there's something broken in the industry. And so you don't have the guys that are built now to go do the exploration because it's so expensive. It's really hard for small independents to go do the big exploration. Frankly, even Hess couldn't really do it. That's how you ended up with Exxon in there is, needing the Exxon money through the downturn to be able to fund that exploration. So you're just not seeing it. And since you're not seeing it, you're seeing reserve depletion and you're seeing global decline rates for oil production rise actually pretty rapidly. And so you're needing to discover more, but you're discovering less. And so that's sort of that long-term bull thesis. So yeah, is there an oversupply now? Sure, right? Is it 4 billion barrels a day? Probably not. It's probably a lot less. But am I phased by it? Not really, because demand keeps growing way above the consensus of it shrinking,
Yeah.
but growing in that long-term trend. And then they're burning the furniture. And so as you burn the furniture, but the demand grows, I don't know, at some point you end up with much higher prices. And again, I just don't think the companies that should have been doing that exploration that aren't end up as beneficiaries because they just don't have that next field they've discovered to generate the high historic return on invested capital and return on equity that they discovered in the last cycles from having invested in prior cycles.
Okay. Thank you for that. And you kind of highlight a point here, which is the supply side of oil and gas is so much more complicated than mining, for example, right? Again, I think of copper, like the majority of the world's copper comes from maybe a dozen mines. Most of it comes from Chile and Peru, a few places in Africa, and it's very simple in the grand scheme of things from a supply side, and it's so inelastic. It takes so long to bring a new mine online and ramp it up to any sort of volume of production. You can predict with a relatively high degree of certainty, right? But when I think about the oil space, right, I think about American onshore, I think about American offshore, I think about all the international interests. Some of them are, independent capitalist systems, some of them are controlled by different governments, some of them are, cartels like OPEC, and all with competing interests. And how do you start to weigh these things to build a view of I guess the supply dynamics? And like I hear a lot of people say, the basins, the onshore basins in the United States, many of them are sort of peaking production, and we're going to see decline in the not so distant future. But then hear other people say, it doesn't really matter because the Saudis are just going to start pumping up supply and they're going to fill the gap on that, no problem. And then there's Venezuela, and who knows, maybe Donald Trump invades and nationalizes the oil or brings oil back to market. There's so many factors here. How do you start layering those things when you're thinking about just oil, and then there's a whole other set of complexities with gas, which maybe we'll have some time to talk about after.
Yeah. I mean, I think it's a great question. I think it's the complexity you just described is part of why I'm not particularly phased when a bunch of folks go and try to measure every individual component of that to
Yeah.
a tremendous degree of precision and then make large claims based on Morgan actually turned me on to this the problems with financial modeling on an individual company basis where the more complex your model, the more likely it is that you're going to be precisely wrong in your understanding of the price.
Yes. Yeah. Yeah.
And so my thought on analyzing the oil market, my approach to it is a little different, where I'll track all of these different factors because each one of them could be the swing factor. But
Hmm.
generally, there's only two or three factors in the oil market in a given year that end up driving the price. And then there's maybe half a dozen or so over a decade that really determine whether you're in a terrible oil bear market or a roaring oil bull market for a multi-year period. So it's really complicated, and I think the complexity and the variety of supply sources, I think, sinks a lot of the folks that try to go and barrel count worldwide.
Yeah.
Because again, it is complicated and there's a lot of it that's unknowable. Um, so
What
I
are
think
these factors that you're really contemplating that swing there?
yeah, so I think probably the biggest single factor is how much OPEC plus spare capacity there is. Because if OPEC is out there, I heard it described recently, they have this got like big stick that's ready to like smack the producers if they overproduce. So if that's the case, then oil is going to be, for the most part, if there's a big potential surplus from OPEC plus, it's an oligopoly. It's not really, and I mean, it's technically a cartel, but it's not enforced in the way that, there's no Pablo Escobar equivalent
Yeah.
for the OPEC cartel. So again, that's where I think oligopoly is probably a better term, or
Yeah.
monopsony, whatever, like the different economics terms for this. But oligopoly is probably the simplest mental framework in the sense that there's not perfect cohesion. And so the the question is, hey, is there 7 million barrels a day of spare capacity, or is there one or two? And if it's one or two and not seven, then obviously that puts you in a completely different place from an oil market perspective. And that's a big question, and you can measure it, and you can analyze it, and you can consider it. And I did go out to Vienna in February. I got invited out to meet with those guys along with some other oil analysts and
To meet
investment
OPEC.
bank.
To meet
Yeah,
OPEC.
yeah, to
Yeah.
meet
Okay.
with I had this really cool experience. They had this whole day where they showed us different stuff and complained about how people get the oil market analysis wrong and whatever. And then at the end of the day, everyone's exhausted. They had us all stay at the Hilton, like across the street or whatever in Vienna. And they hosted some like happy hour thing, non-alcoholic happy hour, which was also sort of an interesting,
Yeah. Yeah.
coming from Houston, Texas, going to
Yeah.
Vienna to
Different vibe.
have a coffee at night. Yeah. So I got to sit right next to Secretary General Hytham, and across from their like head of macro, Ayed. I mispronounced his name. I shouldn't even try. And then there was like one guy from Argus, one other sort of independent analyst, and one other person there. And got to sit with them for 2 hours and chat with them about how they're thinking about things, and sort of what's really going on with their understanding of their group dynamic and sort of how they navigate it. And so I'm not saying that gives me a perfect insight into what they're going to do day to day, but the best I can tell, at Bison, we published a few white papers on OPEC plus spare capacity and how we think that people have grossly overstated it. And at the very end of that, I took their head of macro research aside. I was like, hey, like, I really appreciate you guys keep like having me come to this because we put out this stuff on spare capacity. He's like, Josh, you don't understand. We don't publish spare capacity. Those are our member nations that publish it, and we don't do that because we can't verify it. And then he was a little concerned and a little interested and asked me how I measured it. And I told him, and he said, hey, yeah, that sounds actually. I think they had a couple of different ways the names for our sort of measurement and analytical approach. And basically, we looked at the peak production from each of these countries at moments when they were in price wars and figured, hey, when they're trying to punish each other by oversupplying the market, that's probably the
Yeah.
right way to tell how much, like their peak amount
How
of spare
much they can
capacity.
actually turn on when they want to
Exactly.
do it. Yeah.
Exactly, which is logical, right? Like in
Yeah.
April 2020, and then the one thing I did that people didn't like, but I think it's fair, if you have to deplete your own storage in order to get to a certain supply level, that's not your
Yeah.
supply,
Does it count?
that's your
Does it
supply
count?
plus
Yeah, yeah.
storage. So if you net that off, we're real close right now. And why does that matter? Because one of the big sources of oversupply is this expectation that OPEC's going to keep bringing on more and more, OPEC countries are going to keep bringing on more and more production, and they just don't have it for the most part. And so we'll see, right? I could, a year from now, we could have 2 million barrels a day more from OPEC than we have right now. I just, it seems very, especially at the current price, very, very unlikely. And they agree. So I thought that was really interesting. And you might as well, if you have the bison, right? You face into the storm, you have a big fear, big concern, go figure it out. And I don't think the Saudis would appreciate me sort of tooling around their fields or checking out their data. But you can read their financial reports, and you can look at the Aramco balance sheet and look at what's happening with their bonds and look at what's happening with their dividend, and you can sort of see. I think that there's really not a lot of spare capacity within this national oil company that would have all of it, among other things. So anyway, that's I think one of the biggest factor. And there's one other that we should probably talk about, and there's many others that could be talked about that are of lesser significance. But do you want to talk about the
Yes. Yeah,
one
yeah.
other
Let's do it.
factor? Okay, so the one other is shale well productivity and the ability to sort of force down the cost curve through new discoveries and then through productivity efficiencies like drilling longer laterals, dropping drilling costs, and so on. And so I think we're near the end of the productivity gains where you're getting to sort of the longest laterals you can get. So
Hmm.
the ways that they've improved productivity is one, discovering new fields, which there aren't really new shale fields being discovered right now in the US or Canada. Like we sort of know what's working. The stuff that people are trying to, go into and explore is mostly not working. There hasn't been the next Delaware Basin like
Yeah.
we saw in 2016. Basically, it's just all been downhill from there on a per foot basis. I think you saw productivity peak for oil in 2020 and then for gas in 2021 on a per foot basis. So
Okay.
what they did after the last discovery is they started drilling longer laterals and they started putting more proppant per foot in to try to stimulate the rock better and to try to get more feet of reservoir for per well bore to try to maximize the productivity per well. And that would reduce your cost because you need fewer well bores per amount of rock exposed, and you need fewer feet exposed because you have more sort of proppant
Hmm.
fracturing the rock. So you maximize the fracturing, you maximize the amount of reservoir that's accessed, you minimize the number of well bores, and in theory, that gets you to, and you also optimize the placement. You put it in exactly the right vertical spot in
Yeah.
the rock, and you avoid faulting and other stuff. So you're sort of there now, and maybe you'll get a little longer laterals, maybe not, but
So these are like
um,
perfectly positioned, maximally length, pounded full of sand, basically, and getting every drop of oil out of there or gas as cheaply as possible. Am I
right.
basically summarizing that in layman's terms?
Exactly.
Yeah.
Exactly. That's it. And then there's this really fascinating problem, which is you have inventory depletion. So it's not like there was an infinite number of these wells to drill from the outset. There was a finite number of those wells. And figuring this out, ironically, I think by the time you've optimized your well design and placement and lateral length and so on, typically you're way over halfway through with your core inventory, and you might be sort of 80% through of your original core inventory, the stuff at the lowest break evens and highest
Yeah.
productivity, and you've turned the economics from your tier one, so the one step down from core. You've turned those economics towards core, but even that you're typically about 50% depleted. And so we've raced through, I think it's hundreds of thousands of horizontal wells in the US over the last decade. I have to go back and check the exact numbers, but we've raced through all of the best. Basically, the core is pretty much done, other than a few sort of complicated sections where you weren't able to drill it because of like land issues, or
Yeah. Yeah.
there's a what is that, a potash mine or something in the middle of the Permian and the New Mexico side, so there's some complications on drilling some of that. But outside of like specific like land title issues or whatever, you've basically drilled almost all of your core, and you've drilled almost all of your tier one. And so we're in this weird spot where, yeah, the laterals are getting a little longer and you're putting a little more prop into replacing a little better, you're designing a little better, but those improvements are not forcing the break-even cost down anymore. And if you think about it, for any commodity, if your costs are not falling, they're rising. And once they start to rise, there's a lot of pressures that could force those costs up a lot real fast. If you run more rigs because you're trying to make up for, worse wells on volume, you end up running them less efficiently, especially as they ramp up, and then you more rapidly deplete your remaining inventory. And again, I'm not saying that we're at the peak production for shale. We could produce more at a higher price from here,
Hmm.
but we're probably at the peak economic productivity for shale, at least onshore U.S.
Okay. Wow. So when do you have a prediction on when actual sort of net or gross production is going to start decreasing? Because like I know it's sort of peaked maybe or is slowing down, I guess, the growth, but it hasn't started to shrink as I understand it in any of the basins yet. Or do I have that wrong?
It looks like it started to, and again, this is one of those things where it obviously will matter a lot once it's happened, but there's various things that can keep it from showing up until it's already well underway. And so one example of that is you're seeing there's natural gas liquids, which are
Yeah.
essentially oil products, right? That you can get them from the ground, but also they're one of the outputs from the refining process.
This is like
And you're
propane
seeing,
and butane and
yes,
pentane, the
yeah.
pentanes. Yeah, okay.
Exactly. And you're seeing reports of increased amounts of oil coming from West Texas that's being either rejected or getting punished by refiners because there's too much of these natural gas liquids that are getting blended in right now. And so that's the sort of thing you would expect to see in a decline, not in a boom, right? If you're growing your production, if it's easy, if it's cheap, you're going to just sell your oil and not risk, having the legal and operational issues associated with trying to cheat and stick other stuff in. So you're starting to see that, which is, I think, a reason outside of measurements to think, hey, we're getting into that decline. You're seeing producers who were growing a lot and were not interested at all in anything other than just growing a lot, selling or doing so, like Pioneer, or
Hmm.
doing large acquisitions outside of their core areas. So EOG just bought Encino in the Utica, what was it, 5.6 or something billion-dollar deal. You're seeing them also, in addition to that, going to Abu Dhabi to go drill shale wells in the Middle East, which is fascinating and not really what you'd think. If they still had a lot of inventory left in the core of the Delaware Basin, why would they, you can drill your oil supposedly for $28 a barrel break even. What are you doing? You have these supposedly, they call it double premium wells where they're, 100% IRR at $40 oil or something. If you can do that, what on earth are you doing messing around in the Middle East? Like
Yeah.
why are you there? And so it's not about any individual producer. It's that the pattern, I think, is indicative of you're either in decline now or you're going to be in decline pretty soon. But I think there's a certain amount of uncertainty. Again, there's stuff you can do like sticking NGLs into your oil to try to sort of hide or forestall some of those declines. But I think we're sort of there. And again, I'm not the guy to tell you exactly the day that we've gone into decline. And I've thought we were in decline before and I was wrong. So maybe I'm wrong on this by a few months, but I don't think I'm wrong on this in a few years. And you're even seeing behavior again from the companies that claim they have sort of the most inventory here and so on that would indicate that there are real problems. And you're also seeing those problems not just from those big companies, you're also seeing them from smaller companies, where they might have had a lot of tier one inventory that's now a lot depleted and burned through a lot of tier two, and maybe they're now selling or merging or doing some other sort of big strategic shift ahead of just full depletion and needing $100 oil to come back in and drill the rest of their fields. So you're seeing that sort of M&A, which is potentially capitulation, which again would be a good signal that you're getting into potentially material declines. And then why does all this matter? We're like, okay, why are you even talking about this, right? Like, why not just wait until you can see a big decline? And the answer for that is that the decline rates on these fields are really high. And so once you get into decline, you could potentially see production fall really fast depending on reinvestment rates. And so if you blink, you could miss it, sort of thing. And if you blink, you could go from 58 or 60 or whatever WTI to 100 in that month or 3 months or whatever, as people go from thinking we're
Yeah,
oversupplied
yeah.
to panicking about where you're getting your oil from next.
Okay, so you can get those rapid movements. You've built a view on how do I want to say this? So you have a view for onshore depletion. You have a view for call it OPEC and foreign supply. How do you and you've got a view on growth, which 1% a year consistently for the last 40 years or whatever it's been. How do you, as a money manager, start thinking about how to position for this environment for oil exposure? It sounds like, based on our conversation, you're almost certainly, not buying the super majors. Where are you focused? Where do you think the value lies today?
Yeah, so when we launched Bison, we had this idea that we were going to go buy companies that had, um, solid management teams, survivable balance sheets. I think at the time we called them good balance sheets. What we meant was they could survive a downturn,
Yeah.
and cash flowing assets. And then obviously at a large discount to our view of their intrinsic value. And so what we found is that generally these things you have to give on one of those factors because you're generally not,
Hmm.
even in a very mispriced market, even with capital leaving and whatever, it's generally hard to get all of those. And I think we've done well with that. We've way outperformed versus the small caps and whatever. And sometimes it's on management, and occasionally I've gone and fired management teams and boards and stuff. In other cases, I've just very significantly pressured them into sort of doing what I think they should do, and that's created a lot of value, I think. Um, in other cases, it's been balance sheets, and occasionally that's burned us. So, we actually had, I think, pretty much no bankruptcies during COVID, but we had one a couple years later. Company sort of ended up running up its costs a lot, and we had sold a bunch, but still, that was painful. And then occasionally we'll own stuff where there's a little either less cash flow and more resource or some other sort of attributes. And those actually have done okay, weirdly. Those generally, if we own like a big discovery and then some pipelines and real estate and other stuff, like those actually, the asset intensive things have done pretty well. And so the reason to share what's worked is those are the things that I'm looking for, right? So it's less, hey, this company has the most upside from higher oil prices, because a lot of them have a lot of upside from higher oil prices.
Hmm.
It's, hey, what can survive if this lasts for a lot longer and then have a lot of upside? Where's their compounding value at a really big discount, or where's their, value with some, excuse me, some real significant catalyst where, they're going to go sell this thing or drill some additional wells and grow a lot, or, do some other sort of unlock, or, buy back 10% of their stock a year and grow 10% a year and pay a 10% dividend or whatever, where
Yeah.
you just get this crazy above market return where over a multi-year period you sort of get, because the highest cost guys are not, they're not always the right way to get exposure, I think. In fact, they're usually not. And then if you get into a prolonged period of lower prices, the value degradation is so extreme that you were better off going to, instead of the highest cost guys, the next level down, or even to sort of mid cost type companies where they can compound value, such that when you emerge into a much higher price, there's been that value compounding. So I think it really just sort of depends on risk preferences, and my preferences to buy things that are really cheap, that maybe have, for the most part, not the most upside to higher oil prices if they were to happen today.
Do you focus primarily on the producers and E&P companies, or are you also investing in pipelines and like the other sort of picks and shovel businesses, right? The frac sand producers, that sort of thing.
Yeah, so we'll do both. The focus for our investment strategy is on the producers, but
Hmm.
with a producer focus, producer centric strategy, we've often invested in companies that are 1 or maybe 2 degrees removed from that production. And with that focus, it's actually, I think we've actually done better, and I'd have to go back and double check this, but I think we've done better in oilfield services and pipelines than we've done in upstream, because we've been so careful and so picky
Yeah.
about which ones to buy and when to buy them and when to sell them and so on. There was this one midstream company who used to love to buy. They would basically threaten to or would cut their dividend every sort of downturn, distribution every downturn. And so the same one, it was trading at like 20, and then we bought it at 4, and then went back to 20, sold it, and then it went down to 4 and bought it, and then sold it at 10, and then went back. I mean, ridiculous nonsense where you could get crazy returns in very, very short periods of time. So we'll do that. And again, you can't count on that. There was always risk and uncertainty, but that's worked well for us. And then on the services side, right now we actually have a lot of exposure because I think some of the services have also underinvested, which is part of what has me so bullish longer term.
Yeah.
Like, in order to get the exploration and then delineation and then development, you actually need equipment and people and technology. And if you don't have that, then you can't get it. And the services companies have been bleeding down their rigs that are available and the pressure pumping that's available and the sand that's available and the chemicals. And so, the capacity is limited. The profitability for some of these companies is still actually pretty good as they choose to underinvest and pay off debt and buy back stock. And the quality of the businesses is so excellent. There are still many, unfortunately, mediocre oil and gas producers, especially on the smaller side. Although I guess I've just sort of made the argument that Exxon and Chevron maybe aren't so great either. But on the services side, it's hard to find bad publicly traded oilfield services companies because so
You've
many of
had
them
to
went
be
bankrupt.
excellent to survive. Is that kind of the thesis there? Well, when you talk about how much harder it's going to be for every incremental barrel of oil and how much more expensive it's going to be to get out of the ground, my mind really does go to these, again, these picks and shovel businesses. A couple years ago, we bought a frac sand terminal in the Bakken. And it's an asset that was once the sole asset in a publicly traded company. And the value of that publicly traded company was well, we bought it for about just over 10% of the value of what it once traded for. And it's sort of an irreplaceable asset. The cost of replacing it would be 2 or 3 times to build it that we bought it for. And I we saw it as such a such an undervalued opportunity that was getting paid on volume, and it's just getting paid on volume of sand delivered to market. And so if you we really spent a lot of time thinking about how we could get paid on sort of volume and an asset that was making money at the bottom of the market, and still had upside exposure. And it's gone sort of phenomenally well from there on. And I'm constantly on the lookout for other businesses like that, either in private or public markets, that are going to benefit from this sort of drill baby drill mentality, if that does happen. And exactly what you're saying, just how much harder it is going to be and how much more expensive it is to get every incremental barrel of oil or MCF of gas out of the ground.
Yeah, I agree. And what has me in a lot of these services stocks is this sort of very rare combination. So, I've read a lot of books and listened to a lot of interviews and read a lot of letters from famous and less famous value investors, and it's common to either find companies at low cash flow multiples or at very large discounts to replacement cost, replacement
Yeah.
value. And it's so rare to find companies that are making lots of money, at least relative to their current market caps. Typically, it's because the stocks are down a lot, right? And then they had a lot of debt. And my favorite are those, and then they pay off a lot of that debt. And it's like, okay, well, you have less debt and lower market cap, and you're still making a lot of money, at least relative to this new sort of reset lower enterprise value. And because your enterprise value reset, maybe you're at a fifth or a seventh or a third of replacement cost. And so to me, that's actually probably one of the most interesting kinds of businesses out there. And so we have pretty much our maximum exposure. I actually thought about maybe I should just go set up a separate strategy just to own those. But for an upstream strategy, we basically have as much exposure to those as I think is prudent. And they're just so compelling. They're so well run. There's no compromise on balance sheet. There's no compromise on management. There's no compromise on strategy. These guys are returns focused and operations focused. And these are people who would have garnered enormous valuations in, the tops of cycles. And right now, people just aren't even looking. In one case, there's these two super investors that are like that own a bunch of this one services company, and their other businesses pretty much all trade at giant valuations because people piggyback on them. And this
Yeah, yeah.
one particular oilfield services company, like no one wants to talk about, everyone hates it, no one, and it's fine, right? Like it has a little too much debt, but not a lot too much. It was able to refi recently. And you have these people who literally everything else they own and touch that people are aware of trade at, 8 times EBITDA, 12 times
Yeah,
EBITDA,
yeah.
huge premiums for replacement costs. And this thing is at a fifth of replacement costs. And so, okay, well, are they
Yeah.
brilliant or are they terrible? How much do you hate oil field services versus how much do you love XYZ brilliant, 20% plus compounder over 30 years billionaire? And so to me, it's just so amazing
That
that,
must get
again,
you
maybe I should just
excited
go
to
do more
sort
of
of
that.
see those opportunities, though, doesn't it? Like, doesn't that kind of get you amped up and knowing you can buy these things so cheap and that there literally has to be a repricing at some point, right? There has to be a repricing. One of the
Well,
best trades we ever made was in uranium, and we bought a bunch of uranium equities when uranium was something like $25 a pound. And when we looked at it, it was the simplest thesis in the world. It was that was below sort of the break-even price for any mine in the world to mine uranium. And so, if you had any view that nuclear energy would continue to exist, then uranium miners were like a no-brainer. And the returns bore that out over the next several years. And again, when you talk about this, I see a lot of that same setup. I mean, we bought that frac sand terminal for under 6 times EBITDA, I think, and we're seeing other acquisitions similarly to that. We're working on one right now, and there's just nobody that wants them. No one's interested in them. No one cares about them, and it seems like such a unique setup to me. And I'm interested to hear where you're seeing those opportunities in the sector.
yeah. Yeah, I mean, you could sort of tell I got excited about talking about
Yeah,
that last one. It's sort of, that's my favorite thing is like,
yeah,
the,
yeah.
the macro analysis is fun. It's like great to be a contrarian. It's great to, I think, have like a variant view on this thing that all
But
these
it's
people are
better to just to
selling.
find great deals and to make money. Like that's what it's really
Yeah.
all about, right?
Yeah, really. It's pretty amazing. So, yeah, I think a lot of it for me is trying to avoid some of those specialty services niches. So like a frac terminal, for example, like I'd worry about that. Like there's alternatives to getting sand to wells, and there's other,
Hmm.
there's different technologies that people have used and different kinds of delivery mechanisms. And so, is the right mechanism having a terminal like that, or is it having,
Yeah,
what is it, like a
it's a good
treadmill sort of
question,
thing,
and
or
it's different for different basins and different locations within those basins, and
yeah.
it's complex for sure.
Yeah, and
A
then
lot
what
of yeah.
happens in North Dakota from here, right? Are you going to see, you know, 500 wells a year completed there, or are you going to see 50, or are you going to see 5,000? And I think there's some real open questions there. And I think one of the things I've done on that, and again, it's probably because I'm focusing on it from an upstream perspective and coming in, I'm looking at, hey, where are the best returns for upstream? And then where are they going to come next? And where
And
do
where
they
does
get
that
good or
trickle
bad or
down?
whatever?
Yeah, yeah.
Exactly. And then who benefits the most as you go from, $58 oil to $75 oil? And then who benefits the
Hmm.
most to get to $85 oil and so on? And like, can they compound value as that happens? And so, that's kept me out of some of the esoteric stuff, some of which has worked and some of which hasn't worked and so on. And in some of the mainline sort of services providers, um, where it's less about my ability to identify differentiated technology or differentiated need for infrastructure or services or whatever, and more tracking, hey, is this still the thing that's like, necessary to get more wells
Yeah.
producing or not? And if it is, okay, are there any big innovations these guys are behind on? Yes or no? And then if they're not behind on stuff and there's not really some replacement for it coming up, I can go buy these things. And the downside is that the niche stories like what you're describing can trade up a lot. You can get someone that really needs it or believes in it or whatever. And so in
Hmm.
the public market, that can get rewarded first. And I think I'm okay with missing that in exchange for the near certainty. Nothing's certain, right? You could just whatever
Yeah.
somehow, it's like the what was it, Guys and Dolls, where the guy really wants to bet on one thing, and the professional gambler is like, no, but he covers the guy's tie and says, hey, I'll bet you or bow tie, I'll bet you, you don't know the color of your bow tie. And so similar sort of thing. I'd rather not do that sort of bet. I'd rather bet on the thing that I have a good odds on being right and very low odds, I think, of getting wrong. And maybe that means I'll have to wait a little longer for a return on some of these things, or
Yeah.
maybe it means I'll get a little lower of a return, but in exchange, I think the certainty on it for me is a lot higher.
So, Josh, we've kept you for about an hour now, and I would love to have you back another time to talk about gas because we didn't touch about that at all in this conversation. But before I let you go, can I ask you? You mentioned Rick Rule earlier on in the conversation. He's been publicly pretty bullish on Canadian oil at the moment, and as a Canadian, I feel like I have to ask you, what is your view on Canadian oil? And what are some of the differences between Canadian oil and gas producers versus American oil and gas producers? How should investors be thinking about that dynamic?
Yeah, so it's real simple. Canada is extremely poorly run relative to how it's been run as a country for 100 years or whatever. It's very the fiscal and governance aspects of Canada are extremely poor, and that's reflected in a very, very weak Canadian dollar. And
Hmm.
oil is denominated in US dollars. And so again, it's not about any individual politician. It's just sort of this like sort of societal dysfunction. And I have to study these things a lot to try to not end up with expropriation, or Canada has had issues where their local oil prices have been very low because of insufficient pipeline capacity or whatever. But right now, pipeline capacity is not an issue, and the local currency is very, very heavily discounted. And
Hmm.
so that means that they're selling oil for close to $100 a barrel in Canada, while US producers are selling their oil for $58, before
Yeah, yeah.
local differentials and so on. So that's the biggest driver from what I can tell. The people make arguments about, oh, hey, there's this field or that technology or whatever. And the reality is that from best I can tell, for the most part, that's just a function of there being higher oil. Like if you had $90 US oil, and if the different currency difference had switched and it was $60 Canadian oil and $100 or $90 US oil, you'd see a development boom in the US, and you'd see a slowdown and a lot of the things that people are touting in Canada slowing down. So I don't think there's any sort of magic. It's not, there's different attributes to different oil fields in the US and Canada. There's more oil sands in Canada. There's more unconventional here in the US, different stages of development and so on. But I think the biggest single difference is the currency difference. And the good news for Canadian producers is that Canada doesn't seem, unfortunately, to be resolving this. The bad news is they're not resolving it, but the good news is they're
Yeah.
not resolving it. Canadian dollar has just weakened over and over and over again. And so that's been extremely good for the profitability of these businesses. So I think that's how I differentiate it.
Yeah, I share your view on Canada, and unfortunately, I share your view on the direction it's going, and that there's not going to, or at the very least, that there aren't going to be any changes anytime soon. So, I, yeah, I couldn't agree more. You're seeing the same dynamic amongst gold miners in Canada right now, right? They're mining in Canadian dollars and selling their product in US dollars, and it's a very lucrative time for them. But sad for Canada, sad for Canadians,
So,
unfortunately.
so there's one thing that we didn't talk about that we probably should before we go, and I should probably run in a couple minutes. But the one thing to talk about is similar to that sort of currency effect. There's similar currency effects in other countries. The U.S. dollar has been relatively strong versus many currencies. Um, in the context of other commodities having done well, in the context of, the producers of those commodities doing well from a share price perspective, as well as those prices of commodities, weirdly, no one's really talking about the likely incremental oil demand from this global commodities boom, X oil. And we did some math on it, and we think there's going to be, not tomorrow, but there's going to be an incremental roughly million barrels a day of oil products demand globally
Really?
from,
From
yeah, from the
gold and
moves we've already
copper
seen.
and the mines coming online or expected to come online?
Yeah, and the mines that are going to expand and that are already expanding, and the drill holes and the whatever. And yeah, there's a lot of if you look at the last cycle, you saw almost a million barrels a day of incremental demand. And similar to oil, the easy copper has been mined, and the easy gold has been mined, and the easy silver has been mined, and so on. And so as you have these prices high, as you see literally every day, you see Sprott and some of these other guys with crazy high stock prices as they just
Yeah.
go do equity issuance and whatever. So
Yeah.
that's wonderful for oil demand. And I think your intuition that, hey, these other commodities have done well, when is it oil's turn? I think there's actually this direct connection between that commodity boom and oil demand. And I've not seen pretty much anyone else talk about this. We started talking about this like 6 months ago. I think a couple of people on social media have started like sort of copying it or whatever, but no one's very hard to find any sort of research on this. It's not in anyone's supply demand balances. And I think resource extraction, let's say 3 years from now, is going to show 1 million barrels a day more demand than it's showing right now, plus or minus a couple 100,000.
I think it's underappreciated in general. The what a big cost center diesel consumption is for mines globally, right? Because you see this obviously particularly in the open pit mines, those monster trucks that they use, that burn a ton of diesel. People also underappreciate the fact that so many of these mines are in a Brazilian rainforest or the Canadian Arctic, and the entire power needs are met by diesel generators. So it's often the most expensive, the biggest cost for any mining operation globally is the consumption of diesel. So yeah, I it's not something I've thought a lot about, how that might actually have an impact on oil price, but it does make a lot of sense what you're saying.
Yeah, and the last tie-in there is just there's the technical price analysts got real interested in this a few months ago. They weren't connecting the demand, they were just connecting that there's this tendency historically for gold prices to precede oil prices by about 18 months. Not always, but
Yeah.
often enough that it was worth them talking about, and they started forecasting much higher oil prices.
And is that the
So
connection that the actual mining drives oil price?
yeah, I mean, like there's many connections, right? Like some of it's inflation and money printing, whatever,
Yeah, yeah.
and some of the dynamics that would drive gold prices, for example, higher. But then there's also this physical connection, and that was I saw it and I was like, hey, this is the explanation. I started talking to these guys. They're like, what are you talking about? Like, I don't know. I just see, line go up and then next line go up, and
Yeah, yeah.
okay, so but that's not how I'll see that. I can understand it, I can experience it, but this is the fundamental explanation and connection. And so um, if this cycle is like the last cycle where grades have diminished and mines need to be bigger and it's a even bigger process to access them and whatever, then probably the oil intensity doubles on this new stuff. So maybe it's 2 million barrels a day or some number that's just astronomical. And again, like I don't think people appreciate, like you're saying, how much oil is necessary. And it's diesel, it's gasoline, it's whatever. Like, but also I don't think people appreciate how much oil goes into the mine construction process. And I
Mm-mm.
don't, people just don't think about it. You build whole like tent cities or whole temporary things, and there's all kinds of jet fuel consumption getting people back and forth depending on where it's at, and all kinds of gasoline consumption and diesel consumption, and then the diesel for that big equipment, and then potentially power gen or whatever. So yeah, I just don't. It's been very strange to me that people haven't really been thinking about this or talking about it. And it's not the end of the world for the oil market, right? It's just 1% roughly of global demand. It might be a little under 1%, or a little over, but that's just it's almost like a free year of incremental demand for
Hmm.
oil that's coming. It's probably the whole glut that we're experiencing right now in the oil market is like 2 years out demand just for mining.
Yeah.
So, and
Yeah,
that's been
yeah.
historically what's happened, right? You have a little bit of oversupply, oil's down, you go back to gold in 98, 99 when oil bottoms, and you go back to, it just goes nuts, and then oil follows. And so again, is the technicals, are those right? Are the fundamentals right? I don't know that I have to have a view. I can just observe the connection between the two, and it'll be really interesting to see how
But
it
you
plays
are
out.
right that like grades are down. Mines are getting deeper and deeper and deeper. You're having to move more tons of rock for every ounce of gold or pound of copper you're getting out of the ground, and they're in more and more remote, hard to get to locations, right? So it's like anything, the low hanging fruit gets picked first, and every year it gets harder to mine an ounce of gold than it was the year before, and that's the history of mining in general. So. Yeah, it makes a lot of sense. Well, Josh, thank you very much. Where can people find more about you? You obviously mentioned you run Bison Interests and you have a new newsletter, Bison Insights. What's the best place for people to learn more, get in touch, find out about what you're doing?
Yeah, so I have sort of two separate businesses. So I have Bison Interests. I invest in publicly traded oil and gas companies. And so if they go to, people can go to bisoninterest.com to find out more about that. It's only available to accredited investors, and none of this is an offer, solicitation, or recommendation. So, do your own diligence, consult an advisor. If it's relevant for you, go check it out. If not, I have a big social media following, which is wonderful. I've gotten to meet lots of interesting people like you through that. And so um, I launched this newsletter to be able to share more of my ideas in a structured, compliant manner. And so we launched Bison Insights about 4 months ago, and it's grown real fast, and it's gotten a lot of uptake, which is fantastic. And I've shared different ideas of stocks that I'm buying without any sort of recommendation or whatever. And it's been real fun. Shared some upstream producers, shared some services companies like we talked about, and then also done some expert interviews, sort of like what you're doing, where bring on various oil and gas company executives and industry executives and other investors and various other folks. And so that's been it's rare for me, but it's fun to be on the other side of the camera. I talk too much, so it's nice to
Yeah.
get to sit and listen.
All right. Well, thank you very much and very much appreciate your time today.
Thank you.